Hey traders! Welcome to the Easy Forex Pips YouTube channel. Today, I am excited to share with you a simple yet powerful trading strategy that has the potential to generate fast and profitable results. To achieve high accuracy in this strategy, I will be utilizing not one, not two, but three robust free indicators. These indicators will help us avoid false signals and significantly improve our trading performance. Now, let's take a closer look at the indicators we will be employing in our trading approach. The first indicator is the Breakout Probability Indicator created by Zierman. This tool calculates the likelihood of the next candle's direction based on the previous candle's direction and volatility. By identifying potential breakouts in the market, we can capitalize on profitable trading opportunities. The second indicator is the market structure, developed by Emre KB. It is a technical analysis tool that helps identify support and resistance levels, trend lines, and price patterns. This indicator can help traders spot potential market reversal points or continuation patterns. Lastly, we will be using three exponential moving average or EMA lines. This highly popular technical indicator helps us identify trends in the market by giving more weight to recent price data. By using it in conjunction with other indicators, we can confirm a trading signal and increase our probability of success. Now let's dive into the video. First of all, we will add our first indicator, the Breakout Probability by Zierman. To add this amazing indicator to your chart, head over to the Indicators tab and search for it. And select this one. But before we get into the nitty-gritty, let's first understand how this indicator works. As you can see on the chart, the indicator plots levels along with the chance of the level being hit. It predicts the direction of the next candlestick by analyzing the patterns of green and red candlesticks. The Breakout Probability Indicator separates candlesticks by the color of the previous candle and assigns scores to them based on whether one or more lines were reached. Then, it looks at how many candles in the past have met those criteria and shows that as a percentage value for each line. This way, the indicator can showcase accurate percentages of whether or not the next candlestick will break the previous high or low. Amazing, right? You can also see a table in the top right corner of the screen that shows the total wins and losses, allowing you to see last week's average win rate purely based on its signals. But we will use this indicator with other indicators to get more accuracy. We'll show you the methods to increase the win rate later in this video. Now, if we head over to the indicator settings and click on the Inputs tab, we can see some interesting settings. Firstly, there's a percentage step setting that allows you to change the percentage between the lines. This means you can make the lines closer to each other or further apart. It's important to keep in mind that when trading in lower volatility markets like the Forex market, you'll probably need to lower the step value. This is because an increase of 5% in one candlestick on a Forex pair is very unlikely. Another setting to take note of is the number of lines. You can use this to decrease the number of lines that the indicator plots to make the chart less cluttered. Now, let's move on to how this indicator works. The most basic way to read the indicator is by looking at the percentages and seeing if the price action is going to form a green or red candle. For example, if the indicator shows a 65% chance of the price breaking above the high of the previous candlestick, we can expect a bullish candlestick. But it's not recommended to use this method on its own. There are more profitable ways to use the indicator. One such method involves looking at the prediction of the next candlestick on a higher time frame. In this case, we're using the 4-hour time frame. The indicator shows a high likelihood of the next candlestick crossing below the previous one. So, we switch to the 15-minute time frame and use the long and short signals accordingly. However, we don't enter long positions if the indicator shows a bearish signal on a higher time frame. The third way to use the indicator is by using the levels for your stop loss. For example, if the chance of the next candle reaching a certain level is only 0.1%, we can place our stop loss at that level. We can use that information to our advantage when entering into a position. Now, we will add our second indicator, the Market Structure Indicator by Emre KB. Now go to the indicator settings and change the fib factor for breakout confirmation from 0.33 to 0.273. Let's first introduce the market structure indicator. It is a powerful technical analysis tool that identifies support and resistance levels, trend lines, and price patterns. It uses a proprietary algorithm to analyze past price data and identify important market levels, and be used to identify potential entry and exit points for your trades. To use the market structure indicator in a trading strategy, you should first identify the key support and resistance levels on the chart. These levels can be used to identify potential entry and exit points for your trades. Using this indicator is very simple. We will buy whenever the market price breaks upwards from the green support zone, and we will sell whenever the market price breaks downwards from the red resistance zone. Pretty simple, right? Now we will add 3 exponential moving average lines, but the thing is, in the free version of TradingView, you cannot use more than 3 indicators. So, in order to add multiple EMA lines, we will use an indicator that supports multiple EMA lines. That's why we will be using the 10 in 1 different moving averages indicator. Now go to the indicator settings. We will enable 2 more EMAs, change their types to EMA, and change the values to 21, 50, and 100. Now we will change some of the colors so they're more visible in our chart. Now that we have added all 3 indicators to our chart, let's take a look at how we'll use them all together to make highly accurate buy and sell signals. We'll start by looking at the breakout probability indicator for the 4-hour time frame. Based on the prediction of whether the next candlestick will be higher or lower than the previous one, we will move to the smaller time frames, like 15 minutes, and look for signals provided by either the EMAs or the market structure. If these signals align with the bias we chose from the breakout probability indicator on the 4-hour time frame, we'll enter a position. Simple, right? Finally, we'll base our stop loss and take profit on the values provided by the breakout probability indicator. By using these indicators together, we can make informed trades with a better chance of success. Now, let's take a look at some entry examples to see how this strategy works in practice. Moreover, the breakout probability indicator tells us that there is over a 65% chance of the price breaking above the previous candlestick, which means we have a bullish bias. So, let's switch to the 15-minute time frame. On the 15-minute time frame, we can see it has 68% chance to go market price high. We can enter the position with a stop loss at the recent swing low and a take profit targeting a 2-to-1 risk to reward ratio. I hope you now have a better understanding of how to use the breakout probability indicator and how to incorporate it into your own trading strategies. If you found this video helpful, please consider leaving a like and subscribing to the channel. And as always, if you have any questions or comments, feel free to leave them down below.